To Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have a weekly strategy roundtable discussion where we talk about current market conditions and any questions you might have about your subscription. For those of you who are new, welcome. This is my brief bio. I was Executive Vice President, Head of Technology at Options Express. My background is technology. I've been trading my own money for over 20 years, and we have a team of financial engineers that are constantly building new models and enhancing existing models. Disclosures are very important. If you're new, please first of all type in yes, or first, type in first. Always want to welcome new subscribers. Welcome back everyone else, appreciate your time. If you're new to trading stock and options, I encourage you to pause the screen and visit the link on your screen so you understand the risk associated with trading stock or options. And you can always read the remaining of disclosures. All right, before we get into a trading plan, let's jump into market conditions. So look at spiders. Let's look at the weekly chart. I mean, at this point, most people think about the end of the year, right? So let's just talk about the end of the year. We had a very strong rally from October lows, 410 to 450, 10%, right? We dropped 10% from our July highs, and we rallied almost back to the same level. QQQ is actually at the same level. So the question is, where are we going next, and what can potentially divert this rally, right? We do have NVIDIA earnings. We had AMAT earnings. I mean, they were, I think, very decent. The stock is down 4%, right? Because again, expectations are high. They beat on the bottom line, beat on the top line. Guided within expectations, but you know the stock rallied significantly, so it's pulling back and unable to break through the 2021 bull market. We do have NVIDIA earnings on Tuesday, and we do have then Thanksgiving, and then in December we have Powell speak about interest rates environment, and then we do have inflation data, right? So two things can happen. Market short term is overbought. It's kind of trying to break above 452 level, and we're not that far from 60. So I would say this is your overhead resistance right now, right? As long as we are below 460, I mean, you have 2% to the upside, but potentially, you know, we could drop to, you know, at least 433 level, right? Which is somewhere around 50-day moving average, I believe. Let's just confirm that. Yeah, so 433. So we could drop to 50-day moving average or try to close this gap to 440, or we can go to 460. Probably 10 points to the upside, 10 to 15 points to the downside. So, and you can see momentum is slowly deteriorating, right? Day 1, day 2, day 3, day 4, we're not making new highs. So what is the catalyst to go higher, or what is the catalyst to go lower? On one hand, you know, inflation data is subsiding. So if CPI and PPI data in December, right, the first 2 weeks of December, if it comes in better than expected, then we can have that Christmas rally and potentially retest 460 or even, you know, close to 480. If the CPI, PPI data is not within the expectation, or we have another PMI print, manufacturing services data where it's hotter than expected, the economy is expanding, and inflation and the higher for longer thing comes back, then, you know, we pull back, right? So those are, you know, some consideration going forward. So let's go through these positive and negative exercises, right? One scenario, we are going into the end of the year, we break, right? And maybe go to this, you know, 460, right? Scenario number 1. It could be shallow, right? Maybe this way. Right, so scenario 1, we're making new highs, right? Maybe 2% higher, maybe 4% higher, right? Going into the end of the year. The second scenario is that we break and either revisit 432 or maybe even 200-day moving average, right? Scenario 2. Scenario 2, I mean, they're not that far away. Back to 50-day moving average or 200-day moving average. So which scenario you think is more likely, right? Are we making new highs going to the end of the year, or are we going back to the 50-day moving average? A lot of it depends on CPI and PPI data. Earnings season is over. The only notable earnings, I think, is NVIDIA. Not sure how much. I mean, if it hits a home run like it did in in May, then obviously the market is going to take off. But if it's similar to AMAT, where it's within expectations, slight beat on the up or downside, then maybe, then it just trades sideways or neutral. So 1, we're making new highs. 2, we're going back to 50-day moving average going to the end of the year. You guys are a lot more active than the yellow tunnel. I appreciate that. Thank you. Give a little bit more time for people. So 1, 2. All right, so half of you said 1, half of you said 2, right? Thank you for answering. I appreciate that. Kevin, Andre, Peter, Michael, Steve. My scenario is that I think pullbacks will be shallow, right? We're probably due to revisit 444, 440, right, to close this gap, right? And then I believe CPI, PPI data is trending down. There's no conversations about recession, and toward the end of the year, we'll probably at least retest 460, right? At least retest 460. Again, little room to the upside. I would not chase the market, but on the pullback, if we do get 440 or 436 or 444, I think this is a good buy zone, right? This is where you want to think about adding to your positions. Until we break through this level, I think this is a sell zone. Once we break above this level, then okay, that's your stop level for your sell orders. And a signal to go long. So, and meanwhile, we're probably trading in this range for the next couple of weeks. Going into the next year, that's where you have wide range of opinions, right? I think majority of the people, especially after this rally, believe that we are in the bull market and we're going to break new highs the first quarter or second quarter of next year, right? 500 on S&P and above. Or 5,000 on SPX. Minority of the people, maybe less people, including institutions, think that we're still there's a chance of a recession, the economy is slowing down, and ultimately Fed will not, it's higher for longer. That theme that took us down to 410 will reemerge again, after better than expected economic data. Then we're revisiting 408 and potentially going lower. So 24, right? How many of you say this is going to be we're going to make new highs, right? I would say, how many of you say we're making new highs, at least get to 2021 highs or above in first half, right? First half of the year. How many of you say we're going to revisit or break the lows, right? So again, scenario 2 and scenario 1. First half of the year, which is going to happen first. I mean, both scenarios can happen next year, right? Market could be volatile, we could reach 410 again, and then we could reach second half 5,000. So that's possible, 500, that's possible. I don't think this is, but, I'm talking about the first Q1, Q2. Do you think Q1, Q2, we're going to get to close to 408, or Q1, Q2, we're going to get close to 5,000? So again, 1, up and away, we're in the bull market. 2, the recession is probably around the corner, and higher for longer, right? 2 themes, right? It could be that inflation is actually down, but then we have signs of recession, or it could be that, right, this idea of soft landing or minor recession, right? That could be one scenario. The other scenario is the economy is expanding and recession is ticking back up, right? And then still going lower. So how many of you say 2 to 1? Michael, Mark. Mike, 1, 1, 1, 1, 1. Okay. So most people think 1. I think that is the most popular opinion. I'm going to go with 2. I'm going to take a contrarian view. Same with what I did said last year. I was wrong. I thought first 6 months we actually gonna retest lows and make new lows. It didn't work out that way. This year I'm sticking to kind of this theme that market is overbought. But I don't have to guess, right? At what point do you change your opinion? I think the consensus is you look at the rest of the market, right? You look at the small caps, you look at the banks. As long as we are trading. The consensus is that without the small caps, if you look at the research, just traditionally, you can't have a narrow leadership like we had in 23. In 24, if the bull market resumes and we retest and break through the new highs, we can't have a bear market in probably in crude oil, right? Nor in small caps or regional banks, right? Or high beta stocks. So I propose. I propose to kind of wait. We potentially can break through 180 right in the next couple of weeks. Interest rates are subsiding, so we could get to 200 again, revisit 200 level by January, February. So, but I think that's the line in the sand, right? This is a bull market. If we decisively jump above 200, then I think the bull market we're in the bull market, right? And there's no signs of recession, and we're able to achieve, disinflation without going into the recession. If we are, as long as we're trading in this line, I am still a bear, right? I'm still bearish. So short term, I'm bullish. Longer, medium term, I'm bearish. What is the most important indicator right now? I would say 10-year yield, right? 10-year yield did pull back. We are staying at the 4.3. This is a break. This is the last October, right, from previous year, where the 10-year reached the highs. And now we're basically retesting this level this week. Again, depending on CPI and PPI data in December, I think we're either going to break through this level to the downside and drop to 4%, or we're going to rebound back to 480 or potentially 5%, right? So those are the two outcomes that will influence the market. The reason we had a strong rally in the market, because interest rates dropped by 50 basis points, 10-year yield, right? If we drop by another 50 basis points, we're going to have another strong rally in the market. If we're going to go back, we're going to go up by 50 basis points, well, you're going to have a more than shallow pullback. So most important is the interest rates. It's driven by macroeconomic data, right? It's not what Powell says, mainly driven by economic data. So all eyes on the CPI, PPI data, services and manufacturing data. Short term, it's A, B. It looks like we're continuing lower. That's why I'm bullish, at least short term, right? Consolidation and then potentially another leg down, right? Wave C. You see the same price action in dollar. All right, dollar broke through this level, 104.50. It's continued to trade low, right? Same thing as a 10-year yield. You have A, consolidation, and B, and then C, right? And potentially we went from 107 to 105 too, so we can go from 106 to 104, right? We're probably getting a little bit exhaustive, but I still think that is bullish for the market. So that's still the reason why I'm bullish short term. Long term, I think it's overdone, right? The 10-year drop and the dollar drop is overdone, and then we will have a rebound, kind of similar to 2023 dollar rebound, right? And if we do have a dollar rebound like we did in last year in January, February, then that will put pressure on the market. Any questions on short-term, long-term expectations in the market? So how do we help? We do have a trade spoon. We have different tools, right? Different tools that you guys can use. Kevin can take on by. Yeah, I mean, yeah, Ken Griffin from Citadel, he did say that, people are probably overreacting to this one data point in inflation, right? Powell will kind of clarify this in December and probably the next time we speak. And, just because we have inflation down, we're still pretty far away from 2%. So the conversation that we had in July, in the past 3 months, right, before the sprint, higher for longer, at some point it will come back up, right? And that's kind of bear argument. If it doesn't come back on, right, we have December inflation going down, January inflation going down, we don't have any signs of recession, then market is just going to take off. So for now, probably not enough data to justify this 10% rally, and but from seasonality point of view, we are still in November, December. Usually this is pretty bullish time of the year. Everybody's in good mood, everybody's ready for Christmas and New Year, and up and away. All right. Any questions? We do have elections, right? The elections next year that also creates uncertainty in the market. There is still geopolitical risk. So this is just a scenario assuming there are no black swan events that you can't really time or predict, right? So, and one thing that everybody's learning in the past 2 years, what I've learned the most is that don't trade what you think, right? Don't trade what you think. More important, trade what you see, or what other people think, right? What other people think. All right, the bull market, the idea of the game theory, you have to understand, people, right? People, bulls and bears, right? So it's irrelevant what I think. I never trade what I think. I always trade what I think majority of the people think, right? The majority of the people think right now that the market is going to continue going higher because we're seasonality and there's no signs of recession, and that's the common theme. Well, I go along with it. So that's one thing that I've learned, right? In the past 2 years, just trade what you see, not what you think. You trade what you see, or you trade what you think other people think. Majority of the other people think. So we do have different tools. Stock forecast toolbox. If you've ever been in the live trading room, you'll see that very often I am using stock forecast toolbox. It is showing negative, right? Negative momentum. We're kind of unable to break through this 450, 452. I agree with the model. I don't think we're going to drop 2%. I think that's probably a little bit aggressive, 2.5%. But I think pull back to 444. It probably makes sense, right? So at 450, maybe going short, 444, you're going long. And that's a big difference, right? It's at least 1% difference, right? 1.5% difference between highs and lows. So you want to kind of respect that and use this tool, right? Because if you're consistently buying at the predicted high, right, the data gets updated every day, then you're constantly overpaying. So I encourage you, if you're day trading or even if you're trying to establish positions today, buy or sell, you don't want to sell at 444, you want to sell at 450, right? If you decide to close your position. And that difference of 1%, even a difference of 0.5% on compounding investment, will accumulate, right? If you can save 0.5% every time you enter the trade or exit the trade, over a long period of time, that accumulates, right? And the goal, my personal goal is anywhere from 0.5% to 1% a week. This is my target. It might not be a lot of money if you just look at 1 week, but if you zoom out and you look at 52 weeks, if you can make 1%, that's 52% return plus compounding, right? So then it's more, and that would be the approach, right? I usually don't look for the trades where you can make 10% a day, because to sustain, to be a disciplined trader and have performance over years where you're making 10% a week, I mean, I probably wouldn't be here if I can make 10% a week for past 10 years. So the higher the return you're looking for, the higher the risk, right? The less probability that you will be consistently profitable over a long period of time. So that would be the mindset and some of the tools we're using. In the notes, I do put down that the most important is position size, right? 4 active positions and no more than 2.5% of account value at risk, right? A lot of people ask me, how much should I invest? Should I invest $10,000 into this trade? Should I buy 100 shares, 200 shares? I said, that's not how I think. I think about the anchor point, right? We talked about prospect theory in the live trading room. This is kind of what I follow right now. Always I give this example. I think this is a great example. Just read the prospect theory. I'm going to put that here as a reference point. But the idea of prospect theory, the loss aversion, right? And that the way we feel about gains and the way we feel about losses are skewed, right? Different degree. And we kind of know that, right? We know that if somebody leaves you a bad review, it takes 7 good reviews to make you feel the same way. If you have 1 bad trade, you need at least 2 to 3 good trades to make you feel neutral, right? So you do have that asymmetrical function when it comes to gains or losses. But more importantly, when you confront it, right now, market is up, right? 450. We could be at 460, right? So let's say you made $450, right? You made $450. How many of you will take 50% chance to make $1,000? Right, so let's go to that exercise too. So how many of you say 450? How many of you say I'll take my 50 chance that it will go to 1,000? Let's say you're up $450. Anyone? How many of you say 450? How many of you say 1,000? Or you can say 100% chance or 50. I'll take 100% chance, lock in my gains, or take 50% chance, to double my returns. Anyone? I guess Martin 2, so 50 chance, okay. Anyone else? 100%, okay. Mark, thank you. So some of you said 50 chance, make $1,000. Some of you said I'm gonna take $450. Now the second scenario, right? 3 weeks ago, right? 3 weeks ago when Spiders was, we were at 410, or a week before that at 420, when we were at 200-day moving average or below. Some of you, including myself, some of the positions, I was down $500, right? I was down $500. And then same thing. How many of you, when you were down $500, how many of you locked in your losses? How many of you took the 50-50 chance that you might lose $1,100, right? Or you can frame it differently, lose $1,100 or break even or make money, right? So framing and the way you phrase the question also involves different emotions, right? But if you didn't lock in your losses, that means, you're taking 50-50 chance that you can double your losses or that you will break even. Or so same question. How many of you locked in your losses, right? And took the $500 loss? How many of you took a chance on the market, 50-50 chance to potentially either break even or lose $1,100? Break even. Okay. So if you consistently taking 50% chance, I think there's nothing wrong with that, right? You have an opinion, you think market is going to go higher, that's fine. Same thing, you know. So if you're consistently risking $1,000, you know, to make $1,000, you just need better than flip of a coin system, right? Anytime you correct 2 out of 3 times, well, that means that every 3 trades you're up $1,000, which is pretty good, right? If you set 100% gains, and I also look in 100% losses, same thing, right? You know, you probably grow into your portfolio slower, but as long as you better than flip of a coin, then, you know, hopefully you're making one, for every losing trade, you're making 2 profitable trades, right? And then then you're breaking even. I mean, sorry, and then every 3 trades you're making $450. The research shows that if you don't think about stop losses, you don't think about position size, you always lock in 100% chance to gain $450, and then you take 50-50 chance when you're confronted with losses because of risk aversion, right? We don't deal well with losses, so we try to avoid it. And the problem is that approach, that for every bad trade, you have to make, in this example, 3 good trades, right? So you have to be correct 3 times out of 4 just to break, you know, to make money, right? Or break even. So then the system, it's very hard to make money. So this is the first rule in trading, that you have to understand what the prospect theory is, and you have to be consistent, you have to be disciplined, you have to find that reference point, right? They're talking about the reference point. We all feel different about $450. Some people think $450 is a pocket change, right? Some people are, you know, have to work a few days to make that money, right? So there is no right or wrong, and I encourage you to find the amount, right, the risk amount that's appropriate for you, right? It could be $450, it could be $100, it could be $1,000. You know, that I don't know, but everybody should kind of decide for their own what the right amount is. Any questions? So that's the more important, right? It's not how many shares I'm buying, or how many shares, or how much, you know, how many shares I'm buying, or what the amount I'm investing, but, you know, how much money am I willing to risk, to understand what my risk is. And, you know, Dr. Maneker always said, don't say the word comfortable. You're never comfortable with the losses, but your blood pressure doesn't go up when you have that reference point. So if you trade in $500, right, maximum exposure, and every time your blood pressure goes up, well, then you know that's not a good reference point. Maybe it should be $250, right? But you find that point, and then from that point on, you always risk the same amount to make the same amount, right? So that's the goal, and I think that's the recipe to become disciplined kind of trader. So we kind of spend a lot of time in live trading room. I encourage you to participate in live trading room or watch the recordings. Right. So again, 4 positions, 2.5% losses. If some of these concepts that I explained you still don't understand, or you don't feel like you're a disciplined trader, then I encourage you to participate in Elite Trading Circle. Elite Trading Circle, I will help you to determine position size. And you can see all of my trades, right? GPS, you know, Iron Condor. You know, actually I lost money on this trade, but, you know, I'm managing it, and in live trading I'll explain the risk and how much exposure you have, right? This is a perfect example where, you know, if I'm down $2, right, on one contract, it's $200. If you're doing, let's say, NVIDIA, and doing the same strategy with NVIDIA, of $500 stock, Well, if you're off by 2%, then you're down $1,000, right? So that's why strike price and that risk is very important to understand, right? I said this is a very volatile stock, so if if you're doing one contract on the $10,000 account, maybe you do one or two contracts of GPS. So this way you're still staying within the 2% maximum risk exposure. Right. I don't always trade options, right? I trade stocks. I bought IWM, continue to trade around IWM. It's up right now. Energy. So you have combination of option and stock trades, and more importantly, you can participate live. Or if you're busy, we have recordings. So again, I believe that if you participate for the next 3 months, right? Is for the next 3 months. You participate live in trading room or watch the recordings, right? We have the same kind of guarantee in our one-on-one coaching program. So we do have a coaching program. If you're not considering coaching program, I kind of give the same guarantee that in our subscriptions. If you subscribe to TradeSpoon and you keep a journal, the way I suggest in live trading room for the next 3 months. You document every trade, you always risk the same amount, and you watch the recordings or you participate live, just compare your performance 3 months before and 3 months after. I've never heard anyone telling me, whether it's our students or in the live trading room, that my performance has not improved, right? That never happened. So I strongly believe in that, and I encourage you to take me up on that offer. And if I'm not right, I'll be more than happy to refund your subscription, right? But I think you will have the positive results as long as you follow, Elite Circle or Shadow Trader services that we created, where you can participate live or watch the recordings. If you just need our AI models, our neural networks, exposure to our research, and you already have a trading plan, you know what position size should be, you know how to get in and get out of the trade, you feel like you have the process and you trust the process, then I would consider active trader, weekly trader, monthly trader. Right? We have the models run every day and give you basically different ideas, right? One is Visa, right? So basically model identify Visa is an uptrend. It continues to go higher. It tells you what suggested entry price, strategy A, strategy B based on pre-market, right? If you see market is flat, then maybe you can go with strategy B. If you see market is down, 1%, 2%, then maybe wait for predicted low to 47. On active trader, we're looking for 1% gain or loss. On weekly trader, 2%, monthly trader, 5%. And same thing, as long as the strategy gives you more than flip of a coin, right? As long as you get 60, 70% success rate, 2 out of 3 trades are successful, and you always keep the stop loss and target gain the same amount, then every 3 trades your portfolio should grow, right? That's the idea. But you have to know what that position size is, what the reference point, and be able to manage to entry and exit at the right, using the same amounts. If you don't have a trading plan or you still don't trust the process, then I would consider not signing up for the tools services and follow our guidance, right? Either one-on-one coaching or participation in live trading room, either through recordings or live, right? Because it's a learning process and it takes time. Any questions? Thank you, Martin. Appreciate it. Okay. So what are some other tools we have? So I went over active trader, weekly trader, monthly trader. We also a lot of people ask, do we have stocks? Do we have options? We do have choices for both, right? Just for the Visa example, you can also go in and look for. Still think I would use 1% target gain stop loss, just using underlying stock. But instead of you can buy weekly or monthly options. Right? In this example, with monthly and weekly expire at the same time. So the idea is to buy calls, right? If you want to short-term trade this. Some people like to do call spreads. I mean, it's different strategies, but same idea, right? It's a bullish bias that we express on Visa and some of the other names, McDonald's, Duke, Energy. A lot of people ask, what do we do about Magnificent Seven, right? This is the stocks that are covered the most. I would look for stocks that kind of broke through the overhead resistance, right? Like, for example, Microsoft. I mean, granted, it's down 2% today, so I would be careful. But still, you have a reference point, right? 350 was November highs of 21 bull market. It was the same thing after NVIDIA earnings in July. And Microsoft, spent at least a week or two above this level. So this is a good setup where you don't know how high the stock can go, right? But you do know that if we drop below 350, well, this bull market is on pause, right? So that would be the setup that I would look for. Adobe have a similar setup, right? It cleared September highs and continues going higher. There is no really, overhead resistance, right? It can continue going higher. We traded Micron this week. Same setup, right? It cleared the line, continues to make new highs. Uber has been in the news, right? Clear the overhead resistance, continue going higher, right? There's nothing probably going to stop Uber until it gets to 60. So as long as you're bullish on the market going to the end of the year, that would be the setup that I would look for, right? And AI stocks, we talked about Microsoft, Micron, like AMAT was a perfect example where it benefited from the AI, and generative AI, but it hasn't cleared 52-week high, not 52-week high, but it hasn't cleared this weekly overhead resistance, right? It doesn't matter that it was 2 years ago, but little room to the upside, and could be a lot more room to the downside. So that would be my suggestion. Let's see, Google. So it looks like the same thing, right? So we are, Magnificent Seven stocks are kind of rolling over a little bit. What else? Palantir, right? Another AI stock. Same kind of setup, right? You can see that it faces overhead resistance back from August. So it's a great stock. It's a very popular stock. A lot of people follow it. My proposal: wait till it clears this overhead resistance, right? And once it does, then then you can go along, right? Bitcoin has been in the news, right? We talked about Bitcoin, which was a good, we talked about this here when it had this rally around 3,400, 3,200. And I said, okay, it cleared this overhead resistance, right? Once it clears this overhead resistance, great. Buy it at 3,200. You don't really know how far Bitcoin will continue going higher. You know, if it drops below 3,200, then this rally is probably coming to an end, right? But as long as it's above 32,000 level, you know, it could be 40,000, right? It could be 44,000, right? So that would be the setup that I would look for, whether you're a Bitcoin enthusiast or AI enthusiast. A lot of people ask me about Tesla. You know, it's bearish, right? It's still trading below this downtrend that it broke. It's you know, out of Magnificent Seven, it is the least magnificent, right? So if it's the least magnificent, then you probably don't want to buy it, right? At least not my trading style. Some people like to buy because it's the cheapest. They assume it will converge and it will do a catch-up trade. I like that theory, and I would do the same thing. Okay, you see this downtrend, wait till it gets above 255, right? 255. If it gets above 255, great. But until then, I mean, you do have maybe 20 points to the upside, right? Maybe 20 points to the upside, but to the downside, you have 35 points, right? So that would be my proposal of how to approach some of these stocks. Any questions? Tom, welcome back. Mark, Peter, Tim, Renata is back. Renata, welcome back. We haven't talked about spiders for a while. Not since. Renata usually participates when the market goes up, not when it goes down. But welcome back. Any other? Peter, Patrick, Michael, Joseph, Glenn, Andre, anyone else? Any questions? All right, if there are no questions, keep an eye on spiders. I do see this kind of deterioration in momentum. It's not going higher for the past 4 days, not breaking 452. It would be same kind of setup. Why would I chase the market if there's only, you know, less than 1% to the upside, but to the downside, you know, it's 2%, right? It's 2%. So 2% or 1.5%. So we need to, you know, I would be a buyer on the pullbacks. That would be my strategy. All right, guys, you are great. Thank you for participating. If you're on YouTube and you follow our content, please subscribe. A lot of people watch the videos, but they don't subscribe. Please subscribe, and if you like the content, please share it on social media. Thank you, Peter, Mark, Tom, Joseph, Ferrer, Tim, Renata, Peter, Patrick, Michael, Martin, Mark, Kevin, Joseph, Glenn, Andre, and everybody else. Thank you very much, and have a great day. And enjoy your weekend. I will see you either at the closing bell or Monday morning.